Welcome to this webinar on crypto and insurance. I'm Tom Filby in the insurance team at Mills and Reeve. My focus is on financial lines risks from D&O to commercial crime. Today, I want to spend the next 15 or 20 minutes with an introduction to cryptocurrency, its place within insurance, and a brief focus on what can be done when crypto is stolen. First of all, what is cryptocurrency, or crypto for short? It's a digital currency that can be exchanged for goods and services online, or indeed traded against other crypto or traditional currencies for investment purposes. The best known crypto is Bitcoin, though there are many others emerging all the time. Many see crypto as representing the future of payment transactions, and its popularity is rooted in the blockchain technology that underlies most crypto. I won't bore you with the mind-boggling inner workings of the blockchain, but in effect, it serves to keep a permanent and traceable ledger of all payment transactions, and does so across a network of thousands of independent computers, and is available to view by anyone, including you and me. This in turn lends a high degree of security that makes crypto less susceptible to manipulation than, say, state-supplied currency. And it also avoids the need for intermediaries, such as clearing banks, to confirm each end of a transaction behind the scenes. So when you pay for your coffee in Bitcoin, is paid directly to the coffee house, peer-to-peer, without the need to go through banks. Crypto is also borderless, so no need to worry about exchange rates when making payments internationally. The result is faster and more secure payments and lesser transaction costs. So what is crypto used for? Well-established crypto like Bitcoin has become attractive to legitimate businesses for, as I mentioned a moment ago, its low transaction costs, investment potential, and perhaps appeal to a new generation. The likes of Amazon and Starbucks have started to accept Bitcoin as payment. Second, crypto is fast becoming a mainstream investment in the alternative to shares and as a more dynamic take on traditional currency trading. There are many companies that are now looking to crypto for the investment of their operating profits. Third, you can't mention crypto without crime. Crypto has a dubious reputation for use by criminals, from selling their wares online to the preferred method of payment in ransomware attacks. Crypto can be moved anywhere in the world at great speed and without risking the suspicions of intermediary clearing banks. Further, whilst the blockchain technology means that crypto transactions are visible to anyone, a criminal's identity can, for the most part, remain anonymous, though this is something I shall come back to later. So, how do you acquire Bitcoin? One way is to be the supplier of goods or services that accept payment in crypto. Another way is mining crypto by solving insanely complicated mathematical equations using computers with the electricity supply of a small third world nation. For you and me, however, what is most likely to happen is the following, as illustrated on the slide. First, you set up a digital wallet online in which to store your intended crypto. Second, you use traditional currency from your high street bank account or similar to purchase your crypto of choice, let's say Bitcoin. You purchase this Bitcoin from what's known as a cryptocurrency exchange, which I see as something akin to the foreign exchange desk at Gatwick Airport. It's perhaps worth noting at this stage that many exchanges have stringent KYC requirements before you can use them. This includes obtaining proof of identity of their customers and details of their related bank accounts. Third, upon converting your pounds into Bitcoin, you direct the exchange to pay the Bitcoin to the wallet you've just opened. From there, you can pay your Bitcoin to someone else's wallet or just leave it in your own in the hope that it will rise in value. However, at some point, you will want to cash out that investment, or Starbucks will need traditional cash to pay its staff, and even drug dealers need cash to do the grocery shopping for their grandmothers. At this point, the Bitcoin will need to be sent back into an exchange to in turn be converted into traditional currency and then paid to a regular bank account for use in the normal world. You'll see the relevance of this process when we look a little later at tackling crypto fraud. In the meantime, how does this affect you in insurance? First, there are the crypto companies themselves, such as exchanges and brokers. These are not fly-by-night operations anymore. They're becoming increasingly sophisticated and in many cases are voluntarily inviting regulation from the FCA and similar authorities. As they do so, these companies will be looking for the same insurance protections as is offered to more traditional companies. So for instance, D&O insurance for crypto companies is something that is really being pushed by insurers in the US at the moment. A lack of D&O cover is seen as inhibiting the ability to attract the best directors and enable a crypto business to make those difficult decisions and run as effectively as possible. So it seems only a matter of time before that same crypto D&O trend reaches the London market as well. Second, there is a wider pool of companies that is now getting involved in crypto, whether as part of their sales models or simply for investment purposes. Digital assets like crypto may already fall within the scope of traditional commercial crime, specie and cyber covers, for instance, obviously depending on their wordings. And this is particularly now that crypto has been legally characterized in the UK and elsewhere as property. There are also niche products that are emerging, principally out of the Lloyd's market, that specifically cover crypto investments and crypto wallets against the risk of fraud. And they even provide dynamic limits of indemnity that fluctuate with the price changes in crypto. Third, there are those persons and entities engaged in providing advice and services within the crypto sphere. There is, for instance, increasing pressure on IFAs to know their way around crypto as a mainstream investment product. And with that, obviously comes significant PI risks, particularly where crypto can be very attractive to many investors, but is also very high risk. And not all IFAs may have a proper working knowledge on crypto. Fourth, there are those companies that do their level best to stay away from crypto, but nonetheless find themselves victims of a cyber attack and asked to pay a ransom in Bitcoin. It seems almost certain that crypto issues will become increasingly prevalent in the market and across many business lines. I also suspect that many of the issues triggering cover under such policies will have some connection with a fraud event. That being so, I thought it worthwhile to briefly focus on what can be done when crypto has been stolen or a ransom paid. There is the perception that criminals can navigate the world of crypto entirely anonymously and with impunity. But that's not the case. Law combined with technology and the willingness of insurers to adopt a proactive approach means that stolen Bitcoin can be traced, preserved, and recovered. Indeed, just last month, my team successfully obtained a first of its kind freezing injunction and disclosure order in respect of stolen Bitcoin that we traced to a crypto exchange in East Africa. The key to unlocking this potential has been the legal characterization of crypto as property, in spite of it being entirely intangible. This status as property was first established by the English Commercial Court in an unreported decision of Robertson and Persons Unknown in 2019. This followed a spear phishing attack on the CEO of a crypto fund, which resulted in 80 Bitcoin being transferred to a fraudster's wallet and eventually traced to a UK-based crypto exchange. An asset preservation order was successfully obtained in respect of the Bitcoin that remained within that exchange, or the deposit account within that exchange, in the same way that is possible to do in respect of traditional funds and other tangible property. This view on crypto as qualifying property was further confirmed by the UK Jurisdiction Task Force in November 2019 when it published its legal statement on crypto assets, which recognised digital currencies as capable of representing property with enforceable proprietary rights. And this also coincided with a, this time, reported case of AA versus Persons Unknown, which in this instance was brought by London market insurers. And it was in respect of Bitcoin that had been paid as a ransom following a cyber attack. Again, the Bitcoin was traced to a crypto exchange, but this time an overseas one. Finally, in respect of key case law, there has in the last few weeks been a decision, again unreported, of Iron Science and Persons Unknown. This arose when an investor was duped into investing Bitcoin as part of a scam, it turned out, and it saw him relinquish control of his crypto to fraudsters. This case is important in that the English court was willing to grant a disclosure order against a crypto exchange based outside of the jurisdiction, which is something that the court in the AA case had not been prepared to do at the time. This ultimately comes down to a technical legal argument that seeks to distinguish the jurisdictional limitations applicable to Norwich Pharmacal disclosure orders with those applicable or not to Bankers Trust disclosure orders. It's all very finely balanced, and I don't propose to go into the finer detail here, but suffice to say that it's something that we ourselves have successfully argued before a court, and so it is possible. You'll note in all of this the repeated mention of crypto having been traced to exchanges. The relevance of exchanges here is that it is generally not possible to identify the person or fraudster behind a private wallet. It's only when funds hit a deposit account within an exchange that the prospect of identifying the account holder becomes tangible. And that is through compelling the exchange through disclosure orders to provide the KYC that it holds on that customer. It may help to illustrate all of this with a fraud scenario, and one which could conceivably arise under a commercial crime or cyber or even D&O policy. Take, for instance, a company that has invested in Bitcoin, but its FD was the victim of a phishing scam that duped him into believing that he was sending Bitcoin to one of the company's other crypto wallets, when in fact it was being misdirected to fraudsters. You'll see in the diagram on the slide that 2 Bitcoin is sent from the company's wallet to a fraudster's wallet. The fraudster then splits the Bitcoin and pays 2 parts to other third-party wallets, and 1 part goes directly into a deposit account within a crypto exchange. In respect of the other third-party wallets, you'll see that some of the funds just go elsewhere, they're peeled off, but most are circulated between a series of what appear to be seemingly connected wallets, perhaps in an attempt to confuse the picture. Ultimately, however, a tracing exercise reveals that most of the funds end up in the same place, that deposit account within the crypto exchange. It's reasonable to assume, on the basis of this pattern of transactions, that the owner of the deposit account within the exchange is likely to be the fraudster or a conspirator. Assuming so, then the legal mechanisms you're likely to want to consider will be, first, a freezing injunction or proprietary injunction against the owner or beneficiary of the deposit account, who at present is a person unknown, and second, a disclosure order against the crypto exchange with a view to compelling it to disclose details of the identity of that person unknown, details of any linked bank accounts, and the status of the funds and any recent transactions. From this, and the disclosure in particular, a much fuller picture ought to emerge as to the characters involved and their assets. And in turn, much better informed decisions can be made by insurers on the recovery options. And this may well include taking no further action at all, but doing so with the comfort of knowing that no obvious route to recovery has been overlooked. Along the way, there are likely to be a number of issues and challenges that need to be navigated. And these include, in particular, jurisdiction and choice of law. Now, these can be horribly complex issues, and particularly so with crypto, which is a virtual and borderless currency. Much will depend on the nature of the fraud and the parties involved. For instance, the location of the exchange, or that of the policyholder that suffered the loss, or the location of the fraudster, if this can be reliably determined from, say, an IP address. As to whether London market insurers' involvement is sufficient to seize the jurisdiction of the English court, the answer is potentially yes, potentially no. The AA case I mentioned earlier is a good example. That matter concerned a cyber attack on a Canadian company, and the payment of Bitcoin ransom was traced to a crypto exchange in the BVI. However, the English court accepted jurisdiction on the basis that it had been London-based insurers that had paid the Bitcoin ransom directly from funds that they held within the UK. As such, it could be argued that the tort took place on English soil and that the loss was to an English entity. Perhaps contrast that with a situation where, say, London market insurers are merely indemnifying a loss after it has already been suffered by the insured. So there's no direct payment of crypto by insurers. Would that result in a different situation? Quite possibly. However, it's worth saying that it's not just the English courts that have got to grips with crypto issues. The prospect of using other courts elsewhere, as we have done, does exist. There are also potential issues around the local enforcement of any orders obtained. So even if you obtain permission to serve English orders out of the jurisdiction against a foreign crypto exchange, it may, absent a mutual recognition treaty, still require the domestication of orders in the local courts. So that is something that needs to be considered. Further, an exchange's compliance with orders cannot be guaranteed either. Whilst many are doing their best to be seen as squeaky clean and be as cooperative as possible in civil and criminal matters, there are still some out there, including, I won't name them, but one particularly well-known exchange that simply refuse to comply. Then, even if they do comply, there can be concerns around the reliability of the KYC evidence that has been obtained from the account holder. There will also be a number of claims handling considerations. The obvious one is the costs of effectively embarking what can often be a highly speculative adventure. Though generally we find there's a balance to be struck between costs and obtaining sufficient information from which to make informed decisions on strategy. Second, given the volatile nature of crypto, there can also arise issues around its fluctuating value and the impact that this may have on the quantification of loss, and in turn, the timing of any settlement or determination of a claim or indemnity. Further, and more specifically in respect of ransomware attacks, where data has or may have been exfiltrated, there may exist real concerns around the prospect of retaliatory action by fraudsters if they find out that the ransom that has just been paid has also been frozen by the same people that paid it. These are just some of the issues that can arise in this ever evolving area. So in summary, crypto is gaining mainstream popularity, and it's likely to become an increasing feature across insurance products out there in the market and in the nature of claims under those insurance products. Second, working in collaboration as we do with specialist investigation companies, stolen crypto can be traced, and the legal mechanisms are now there to preserve crypto for recovery. I hope this has been interesting and helpful, and I thank you very much for listening to this webinar. Please do feel free to email me directly with any queries. Details are on the slide. And in the meantime, have a fantastic day. Thank you.